Welcome to the Frontline podcast, brought to you in association with the Atla Group. Atla Group is a collaboration of businesses with a collective history of over 130 years, bringing financial solutions to its clients in the world of accountancy, audit, advisory, fiduciary and retirement benefit solutions. Visit atla.im today. On the Frontline podcast, we chat to leaders in business and successful entrepreneurs to bring you their in-depth and bite-sized opinions that will add value to you and your mind.
Mary, thanks for joining us today. I appreciate it. So, never a settled time in the world. We kind of come through COVID as a human race, almost, which affects markets, investments, etc. And then not long after, Mr. Putin gets busy. How have you found that in the investment market coming out of one, I suppose, crisis, if that's the right term, into another? How have you handled that? How are you finding it? How are you finding clients dealing with that?
Well, it's really interesting, Martin, because we already experienced quite a significant rotation from growth stocks. So, the sort of meme stocks were very popular in the COVID lockdown, what we call pre-revenue companies that really don't have much to show for them, but were priced at quite high levels, into the value section of the market, where which ultimately benefit from higher interest rates, and because of their valuations are low, so they're regarded as sort of low duration stocks, if you like, or like a short duration bond. They perform better in rising expectations for interest rates. So we'd already seen that happening before Putin invaded the Ukraine, and then after that, really, markets haven't actually moved an awful lot since then, which is kind of surprising in a way, because obviously we've seen oil prices peaking at about $140 a barrel, and crude prices coming back down to around 106 this morning, but still pretty high, and obviously a lot higher than they were in March 2020 when they were in actually negative territory. So that's been feeding through to inflation levels, which are obviously a lot higher now as a result of that, and I think prolonged our already elevated expectations for inflation that existed before Putin's invasion. We also have had the lockdown in China because of their zero COVID policy, which is it's just starting now to emerge. I believe 12 million of around 22 million residents of Shanghai have been released from lockdown. So we're starting to see that ease, and hopefully that will also ease the supply and demand pinch points that we've been seeing, of which we were still emerging from COVID last year. So there's been an awful lot to contend with, and I think equity markets certainly been quite sanguine in the backdrop of that, and you wonder why in a way. But partly the reason, I think, is because if you look at what bond markets have been doing, global bond markets have fallen by about 6% in the first quarter, and equity markets are down about 5%. So there's been no real obvious safe haven areas to go. Nobody wants to be in cash if inflation is raging away at 7%, because they're still going to be guaranteed negative real rates. So it's not been an easy situation from the headline perspective, but as I say, equity markets have been sanguine because I think people see that there are real returns to be gained still in equities. It does depend on how long inflation goes on for, and how much margin squeeze that we see on equity balance sheets, on company balance sheets. So there's still a lot of uncertainty there. Yeah,
so that inflation. Yeah, I suppose you had a crystal ball, but where do you see that moving in the coming months, and I guess probably years? Even you think of just household costs and cost of living for people, let alone we're talking about the investment and market.
Well, it's still extremely uncertain, but I think we are beginning to see some tentative signs. I say tentative because it has been happening before the Ukraine situation and before China's big lockdown more recently, but we are seeing some tentative signs of inflation pressures rolling over. We've seen freight costs dropping quite considerably. As I mentioned before, China's starting to come out of its lockdown now. I don't think it can stay in zero COVID forever. We've also seen significant deceleration, if you like, in core inflation. Is still high in the US, but core inflation has decelerated once again this month, this most recent reading. And one of the key factors that was driving that headline inflation was also used car prices, oddly enough, which were up by sort of 24% year on year last year, and they've started to come off quite rapidly.
What's driving that particular cost sector?
That was really due to the fact that new cars weren't being produced, either through supply constraints because of COVID and also because of chip supply constraints because of COVID as well. So these are all post-pandemic tail risks, if you like, that have come through the market. So it's important to recognise that there's still a lot of exceptionals in these numbers, which hopefully from a household perspective means that eventually these will start to ease. The one area we do see potentially being sticky in terms of inflation is with wages. Now that should be good for households generally, but it depends on how sticky it is, because we are sort of seeing a very small uptick in unionisation across the board. Amazon was a big case recently when one of their outlets decided to join a union, but again, that's not typical of the company across the board. So it's just nascent signs of that, but that's a potentially slightly more sticky area of inflation, which obviously the central banks will be keeping an eye on because the labour market remains tight. People have not returned to the workforce, especially the 50 plus demographic after COVID. So that's going to be a problem, I think, which will last a little bit longer. So to answer your question in terms of longer term inflation, I think we are looking at, staying above the Bank of England's prior target of 2%. So I think 3% by the end of the year, hopefully. Could be a little bit higher than that at these levels. A lot of economists are currently really behind the curve.
Right, okay. So that's interesting when you talk about, and factored in a couple of times there, I suppose you look at supply chain being an issue, a tail issue from COVID. When you're looking, and you talked about data on investments, then there must be, when you're analysing the data, there's obviously these anomalies that you have to try and spot as well, that perhaps the data you're reading is just spikes in issues, and that must be a difficult challenge within the investment markets to spot those.
It is. I think ultimately we have to just keep very close eye on our stocks that we invest in, because market headlines don't always belie what's happening with the companies underlying. So, for example, we've had a number of first quarter results out from companies recently, which have actually been pretty good. Some of them actually benefiting from inflation. I believe, Bunzl is highlighted. They had their first quarter results yesterday, the distribution and services company. But they have a cost plus model, and they're able to pass on a lot of the inflation costs to their end users and their end markets. I think they were tipped as a buy in the Times this morning as well. So some companies actually benefit from inflation. Others, and obviously there's real assets as well, which have done very well. So the likes of the copper miners and the gold miner, gold finally performing after a period of latency, which is typical gold price performance, to be honest with you. And obviously oil and gas as well. So, but we are looking really at margins and seeing how companies are coping on their margins with the squeeze on cost of input prices and wages. And we have to start from a position of strength. So we have a lot of high margin companies in our portfolios. So even if they do face a margin squeeze over the longer term, we think they can cope.
And I presume also there'll be with the Ukraine issue, and I've seen commentary around wheat, oil, and where there's a transition period really, where if they've been our main supplier area and that's cut off, that will come back on tap, but it just needs time, whether it's for the weather for a season of wheat, or I guess for oil, oil being sourced from other regions. So I assume there's almost like a transition in that.
Yes.
Certain supplies that come from that troubled area at the moment.
Definitely. I think we can't be blind to the fact that Russia is a massive wheat producer. Ukraine, sunflower oil, I think something like 80% of the world's supplies come from the Ukraine. So there are going to be those pinch points. I think from a food and again household income perspective, unfortunately it's the poorer household incomes that will fare the worst, because they spend more of their disposable income on food. And also the emerging markets, which is another area. We've already seen Sri Lanka going into effective default, and our friends in South Africa are squeaking a little bit at the cost of food now, and they have obviously a lot of poverty there, and they're worried about social unrest. So these are more a worry, I think, in those parts of the market and those parts of the social structure. And certainly if food price inflation goes on for a longer period than perhaps we expect, either through sanctions or through just lack of supply ability, and also to replant those crops as well, because of war and disruption, We think that could be problematic from a political perspective long term, because you see, more people being disgruntled with their standard of living, and therefore swinging to the left and so forth. So, or to the right even, I don't know. But we will see more volatility in politics. It's coming through in France at the moment with Le Pen and Macron and their forthcoming election. So she's doing a lot better than...
The world's not come to an end, though, is it?
Oh, God, no.
It does feel a bit that way at times.
No, not at all. Again, it's when you look at the company returns, they're actually doing quite well. But it is going to be tough. It's going to be tough this year for a lot of households and for people in general. We saw Netflix last night hasn't lost subscribers, but it only gained another 200,000. It was expecting, a lot more than that. Last night, their shares fell 40%. It was crazy. Right. After already having fallen 40%. Thankfully, we don't own Netflix, at least not directly anyway, and have very little indirect exposure to it as well. But
and I presume that's just households looking at their outgoings and
saying,
cost.
I'll have Disney Plus, but I'm not having Netflix and Disney Plus, or vice versa, because Disney Plus is probably going to suffer as well. And these are discretionary items that people don't necessarily need, but they do need to put petrol in their car and food in their stomachs.
Yeah, right, of course. Not to get into the weeds with Netflix, but that seems quite a big drop, 40%. Is that a market reaction, and everyone's kind of generally on, let's say, on tender hooks because of the general global situation? That I wouldn't say people are panicking, but there is more
I think
reactive nature to these news.
Yeah, I think Netflix is twofold. I think one is the price. It was already significantly overvalued in terms of its valuation. Now, whatever you might think of Bill Ackman, who dumped his big stake last night, it's operating in a very competitive environment. It's very cash flow hungry because they have to buy content all the time. It has to be better than what's being developed by Disney Plus. And the second issue with Netflix is the fact that they came out with a very mixed message yesterday, which is a total change to their original ethos of being very happy with subscribers sharing their content, but now they're saying no, if you're sharing your login with another household, we're going to make you pay for it. Right. And by the way, we're also going to introduce ad streaming, which nobody really wants, or you can get it at a lower price, but is that going to cannibalize their existing subscriber base? So there's a lot of uncertainties in that strategy, and it seems like they're shuffling the deck chairs a bit, which is why the market reacted so badly last night. And
does that go back to the comment you made at the start there about values in companies? I think you call them pre-revenue values. So that would be an example, Netflix, where there's potentially a lot of pre-revenue value built into the share price.
I would say so. I mean, it is a revenue-generating company, and more recently, it's a cash flow positive company. But it has spent many years in cash flow negative territory because it has had to spend a lot of money beefing up its content to compete in a very competitive market. It's not what I call what Warren Buffett would call a wide moat company. It doesn't have that pricing power and that oligopoly type feel to it. It's in the sort of turbulent sea of consumer desire, and it's not an area that we tend to invest in a big way. We tend to stay away from consumer discretionary, and we're much more consumer staple oriented. So we'll buy the bread makers rather than the Netflix subscribers.
Okay. Yeah, absolutely. Yeah. So just one final quick question. The future, again, go that crystal ball. We touched on inflation, interest rates. As an investment manager, what are you talking to clients about at the moment? How are you sort of pitching the future and keeping clients, I suppose, comfortable?
Well, it's really interesting, Martin, because I was actually answering a client email this morning, and we've had two different sort of camps of thought. I think some clients have been, generally speaking, clients have been very sanguine because, as I said before, equity markets haven't moved too much in a negative direction. There's been a little bit of negative pressure this year, but those that have sort of spoken up have said either that they've wanted to take risk off the table, which we kind of discourage to some extent because we think, well, where do you go for low risk return after inflation right now? But then we've had other clients who, I have to say, are generally of the older demographic who knew the 1970s, or they come from an area of higher inflation, and they're saying, I want more real assets. I want more real assets. I want more copper, and I want more gold and oil and banks and things that will do well in higher levels of inflation. So it's a very split view at the moment. But in terms of where it's going, again, that's the $1 million question, isn't it? As I said, I think inflation is there are some indications that it's starting to roll over, but obviously that also depends on how sticky wage price inflation is going to be. I think I've sort of indicated, I think we expect the Bank of England's target to be exceeded for some time yet. It's going to be above 2%, but hopefully not much more than 4%. The 5-year break-even rates of inflation, so effectively the yield on inflation-linked bonds minus the nominal on ordinary gilts, is about 4% over 5 years. And that seems high to me, but then maybe it is. Maybe we are going to see 3 to 4% inflation levels over the next few years. And on the interest rate side, I mean, Bank of England and the Fed have been behind the curve until recently. I think markets are finally accepting the fact that they're catching up now, and the Bank of England is forecast to the base rate is forecasted to reach about 2% by the end of this year, maybe up to 2.5%. I think probably a little bit beyond that as far as we're concerned. And the Fed, certainly the next interest rate rise will probably be 50 basis points, and maybe even the one after that. But still, we're not talking 1970s interest rates here, and I'm not sure we can go there, because of debt levels are so high. Generally speaking, I think corporates can probably cope with it, but sovereigns, after the coronavirus pandemic and all the spending, and also personal households that have become used to having low levels of debt financing for decades, I'm not sure we can go back to 4 or 5% interest rates, but we'll see.
Interesting times ahead.
It is, yeah,
and
definitely.
a lot of challenges. Thanks for joining us today, Mary. I appreciate your time.
Yeah, thanks, Martin.
Thanks for listening, everyone.